All right, good afternoon. Welcome back here to Trader Minute. Great to have you aboard. We have a new signal on the board here, and that is with Micron. So going to go out and trade it, and not a company that has earnings, in its way. They've already had earnings, and the options are pretty reasonable for Micron. Now, interesting stock because this is one we talked about last week, and had this kind of heavy breakdown on Friday. And, it was one that I even mentioned on Friday. It surprised me that it wasn't a bearish signal, with how it sorted out. Right now, I'm getting a bullish signal come into it here on some of that option expiration whipsaw that it had, which, we see quite often. There's a reason you hear me say quite often that, hey, making major decisions around option expiration based on charts, it just isn't all that fun. So let's go out and trade it. Now I'm going to come into the November options. They're not quite 30 days. I could come into the 32 days and buy buy a little bit more of a spread. But I'm going to come in with the 15th of November 45 calls, and I'm looking at 8 contracts. Now, what is this going to do? Well, this is going to put, about 1,500 here on the trade. And what that will mean simply is that I don't have cash for another trade, until Micron, is over. But the way Micron kind of sorts out here, I'm good with that. I'm good with that. It is Micron. It's one that, typically, we're not going to be in long. It tends to move. It tends not to consolidate. So going to go buy 8 contracts here. Got filled at 184 of the 15th of November, 45 calls. So let me make sure the alert goes out here. And then we'll go and fill in the spreadsheet with all the data here. But Micron call options were purchased. Ticker symbol, or the ticker MU for Micron, and $1.84 was the entry price on 8 contracts there. And this is the 15th of November. Okay, 15th of November, 45 calls. Okay, 15th of November, 45 calls. All right. And there we go. The alert is out. So let's come into the spreadsheet, and we'll fill out our trade data here. So we'll come in here to Micron. Today's date, 10:21 p.m. session. The options were the 15th of November, 45 calls, 184 entry on 8 contracts. Now the stock price, as it on entry here, was 45.27. So 45.27. The average true range here for Micron today is 156. All right, so 156 average true range. And so that's going to give us our stock exit levels, our profit level, and then our current stock price, which, it's a little delay, but there we go. And then that'll put our auto exit date. Now, the red date will be here on the 24th, which will be, Tuesday? Will be the date there. So 10:24 p.m. And the auto exit date green would take it into the 29th, so next week there. So 10:29 p.m. And there we go. There we go. All right. So our cash in, just under 1,500 there on it, and trade is open. Now let's go fill in the metrics here for it, the delta, the gamma here on it. So we have a 435 delta and a 26 theta. So 435 and 26. and then our Vega here on it is 38. Okay, so those are in, and our market vibe here today is a 6 and bullish. And so those are set. And I'll fix the formatting here in a little bit. So there's Micron, right? Now, that leaves us with, just over $500. I'm not going to put $500 into a trade, but so we'd have to peel some off of Micron to get into the next trade. It would be nice to see Micron go and move up to that, 2 average true range spot. If we look at the chart, the 2 average true range spot puts it at kind of the gap fill. This earnings gap fill is what it puts it at, which is a really interesting spot. So we'll be rooting for that and looking for a gap fill here for Micron. It puts our stop here on Micron at let me come into it here. Puts our stop, at 43.71. So that's just under today's open price here, which, it's, if we were just talking about the candlestick pattern, that's where I'd be looking at, putting a stop at on any sort of upside trade here for Micron. All right. So into Micron and running with it. All right. Now, wanted to address a question that Michelle forwarded over to me that I promised I would address here. But the question is, hey, I was wondering if you could maybe touch base on something I have a habit of when I'm looking at the option contracts. I have a tendency to look at the open interest on both calls and puts at the various strike price. I don't think it's a good thing for me to do because sometimes I will buy an option based on those numbers instead of what the charts are telling me. I realize that there are market makers and that buy and sell them both on both sides, like 10K open interest on a 30K call strike and 1K open interest on the same put. The charts are telling me the stock is likely to move up. I'll see the difference and buy that call option. A lot of time goes against me. Help me change my rationale, and thank you. Yeah, so there's an idea out there, and you'll notice when I came in to make this trade, I have Delta and Vega up. I don't have open interest up. I don't have volume up. I don't care. I just simply don't care. Now, that's not the case with all stocks and all trades, but when it comes to open interest, it is something that gets talked about a lot in the market because when you have option expiration or when you have, everything else silent, it becomes a really good explanation for why something happened. The problem with that is that it is simply an explanation for why the eighth most important thing happened. There are a lot more other important things. Just take Friday, for instance, right? Do you think, J&J really cared about any of the open interest on any of the strikes? You think Boeing cared? Do you think Microsoft cared? Microsoft had some, really easy pin targets, but things took over in the market. Well, those are more important than the pin targets, when it comes to, an individual stock, right? So, it's one of those where I will look at the open interest if I'm trading a weekly option. If I'm trading something very short term, and I have about 2 days left on it, right? If I'm going to go trade a Micron, Micron option for this, for this week, yeah, I'm going to look at the open interest. I'm going to care a little bit more. I'm going to see if there's anything that's really out of whack, unbalanced. In the case of Micron right here, there's not. But I'm going to be very slow to read anything into it. Just extremely slow. Because when it comes to matters of importance, it's one of the things that is just lower on the scale. And yes, does it come into play from time to time? Sure, it does, right? It certainly does. But it is not a driving factor, 95% of the time. And so, I kind of throw it into that category of things I just can't control, right? And of things that are just TMI, too much information, too much out there. If I have a good risk reward, a solid chart setup, fundamentals that I like, great. You know what? Unless there's something glaring on the options, then I'm not gonna, care too much. I'm going to run with it and make the trade happen. But it is one of those things where I know people try to read a whole lot in, but even if you watch TV and you watch those that read stuff into the options, because there is a game there, right? There is a game there. How often do the options really call it, right? We always hear about and repeated about the times where it works, where, you know what, there's huge option volume going on here and here and here. And then, okay, when it works, everyone's like, wow, that was amazing, right? But how often does it not work, right? And so the way I look at option volume is if I have a stock like Micron, and I pull it up today and I look and there's just something crazy going on with the volume today, I know that I'm not the person who's in the know. I understand that, look, somebody knows more than I do, and I have a choice. I could say, well, I'm going to ride with that, or I can go figure out what it is. And, sometimes, you simply can't. You have to say, well, I'm going to take that risk. I'm going to go on with them and just take that risk that they are, they know what's up. But I've done that enough times to know, look, it can, you can buy something that everybody's buying calls on one day, and the next day the stock's down 5%. Right? It happens. It happens a lot. It's, it happens reverse, right? Because you think about, you think about this, and I've done this from a fund manager standpoint, and I even did it right back here, obviously not with enough volume to matter. But here's Netflix. It's on the tank, right? It is tanking. Everybody's on TV talking about how bad Netflix is and the competition, and a story I don't buy at all. Like, I just think it's an absolute ridiculous story for so many ways. This idea that competition for Netflix from Disney is a negative thing. It's a negative for Comcast. It's a negative for DirecTV. It's a big negative for Dish Network. It's a huge positive for Netflix because it's just going to get more people to cut the cord, and it's going to get more people to say, well, you know what? Forget Comcast. I'm going to go with Netflix and Disney. Right? From a price standpoint. And I think it's actually going to boost their subscriber numbers over time, which I know, not a popular opinion, not something you hear about on TV a lot, and everybody's worried about the competition, and we see the stock tank, right? I want in. So what do? Right? Well, on this day right here, I went and sold some puts. The put values were really inflated because of the implied volatility. And so I added volume to the puts. Now, if I were a massive whale fund manager out there doing the same thing, right, it's going to hit some scans and people are going to talk, well, hey, look at all the put volume. Netflix must be going down. Netflix must. What, did I buy those puts or did I sell those puts, right, because I was bearish? No, I sold those puts because I was bullish, and I sold them down. I had a nice cushion because of the price, and ultimately they paid off phenomenally. But what did I do? I then turned around, and on this day right here, 2 days later, I added shares to my position. So there I am, increasing the open interest on the put side and buying stock. Right? That is something we see fund managers do a lot. It's something that most traders don't kind of get that mentality of, hey, you know what? That's what could be going on. And they just look at the open interest and the volumes and go, hey, you know what? It must be directional. But more often than not, heavy volume in an option is not directional. But when it is, it tends to be really big, right? Because somebody does know something and they load up huge and they score big. And yes, is it unfair? And did they have inside information and all? Yes, yes, and yes. But it is part of what the market is. And, should it be that way? No, you know what? It doesn't matter to me because I have no power to change it. So it's not something I'm going to, fuss about. It's more just, hey, I'm going to understand that's what it is. So, when I'm trading a stock that, I'm familiar with how the options work, I've traded Micron options hundreds of times in my lifetime. I don't look at the open interest. I don't look at the volume. I don't really much care. We hear some people talk, well, you have to have certain open interest on an option to go trade it. Well, that's a 10-year-old mentality, right? You want certain open interest 10 years ago because, look, you need liquidity and a low spread. If the open interest is really low, then the spread's going to be high and the liquidity is going to be low. So it's going to be tough to get out of your option. Well, that's gone for the most part, except for certain stocks, right? And I know the stocks on my watch list that tend to have higher spreads, and I'm basing it off of spreads, not open interest. I'm willing to buy a stock with or an option with zero open interest if the spread is right, and if I know that spread isn't going to balloon because of experience with that stock. But if I don't care if there's thousands of open interest and the spread's 30%, I'm not making that trade. Right. So to me, open interest volume, very overrated, overused. And so, yes, you use them, but understand that they're 7, 8, 9 on the list of things that matter. And by the time you start getting down to that list, well, you're probably into the TMI mode in terms of, over-analysis there. So anyway, hopefully that answers the question. If not, please shoot over to support and Michelle will get that back to me there. Now, other thing I want to do here this afternoon is take a look at the earnings insight. Now, this is from FactSet. They put this out every weekend. And yesterday we had, pretty much the first kind of full week of earnings season. And you can see with 15% of the companies in the S&P, they've reported, right? 15% have reported. And that's, typically what it is after the first week. And, Micron's included in this. FedEx is included, and they reported a few weeks back. Nike, those off cycles are included in this. After this week, the numbers that we see will likely be the ending numbers. So we'll have about, 30% of the companies having had reported, and the numbers will be the same when it's 100%. Right? Statistically, we will have enough. Right now, we haven't had enough, statistically, and we haven't had enough diversity in the earnings to really say. But 84% of the S&P 500 companies that have reported or have reported a positive earnings per share surprise. 64% have reported a positive revenue surprise. That's interesting. Those are big numbers. Those are big numbers, when it comes down to what they are relative to the expectations. Okay, 84% is above the 5-year average, right? In terms of earnings, and significantly above. They're also beating, though, below the 5-year average. So, yeah, we have more companies beating, but their beats aren't tremendous, right? And basically that's what we are seeing here. The number of companies beating on revenue, 64%, is above the 5-year average of 59%. So that's a pretty good number there, right? And the revenue percentage is 1%. So they're beating by about 1%, which is also above the average. So when we look at the earnings season and the positive vibe that it is set, right? Earnings matter more, revenue matter more. Well, revenue matters more. And companies are beating revenue above, more companies are beating on revenues than normal. And the amount in which they're beating by is greater than normal. Now, it's not, massive off the charts type of, beats, but so far, that's a pretty good number, right? And I'm more interested to see what it says by the end of this quarter, but we'll see. Now, one thing that concerns me about this quarter are the profit margins. Profit margins are down. Now, profit margins have fell in fourth quarter and first quarter of this year. We had gone through a real nice profit margin surge, but when profit margins fall, we tend to see the stock market struggle a little bit. And so far, profit margins are on a slight decline here, in terms of the growth rate for those profit margins. And so we'll kind of see how that plays on out here. But, we really have not seen enough of an aggregate, across the board to really kind of say, hey, this or that, right, that is affecting it. Because right now, healthcare, financial, they're kind of dominating the earnings that have been reported. But bottom line, the profit margins, they're still pretty good. We're not talking about 2016 profit margins. We're not talking about 9%, 10%. We're still talking about up over 11%. Double-digit profit margins, that's a pretty good positive for the markets. And so, year over year, is there an earnings decline? You betcha, right? The earnings are not as good, and they're not expected to be as good as they were last year at this time. And we are seeing that, happen. And, we talked about that on Friday with Schlumberger, right? Yep, they've been on these earnings declines. Halliburton, for instance, who reported earnings this morning, they've been on these earnings declines, but okay, now the numbers are going to get a little easier. Going forward, are they going to be talking about earnings growth or earnings contraction, right? Here's Halliburton this morning on the earnings per share, pretty much came in on consensus. The revenue missed pretty big, right? And the stock gapped down, and rightfully so. You say, well, okay, the stock should gap down, but what's it done ever since? It's pretty much rallying. You say, well, why would it rally? It missed. Well, when you start looking out and you look at the comparisons going forward, man, you know what? Next year at this time, revenue expectations are at 6,000, up here. They have to compare to down here. Even if those are downgraded, we're going to be talking about revenue expansion, not contraction. And recently, Halliburton's been in a revenue contraction phase. And so we're moving from, a lot of companies from this revenue contraction or earnings contraction into a revenue expansion, earnings expansion. Now, the bears are going to argue, no, this is never going to be realized. We're going to have this, that, and the other. The economy is going to go to hell in a handbasket, so we're not going to realize that. But when the market's looking at the earnings reports so far and the estimates that are coming in, that's what it shows. And that is, that's a big deal. So, yes, we do have earnings contraction, but we do have, revenue growth that is coming in. And, as long as revenues are growing, the market is not going to be overly bearish. It just isn't. It's going to need a big catalyst, to go bearish. Valuation, it's above average. It's always above average. Valuations are going to be higher. Why? Because the alternative in bonds, it's not much of an alternative, right? If bond prices, if you could go and get 6, 7, 8%, by buying bonds, the stock valuations would be well below average. Stock valuations would tumble. People would say, well, why go buy Apple when I can just go buy, Apple is kind of expensive, or Microsoft is kind of expensive. Why go buy that when I can just go buy a bond and get 8%, right? Well, we're not in that environment. In fact, bonds simply do not pay, which makes stocks more attractive. And, that same story continues to play out. So, you can go through more of it here. Just, if you Google search FactSet Earning Insight, it'll bring it up here for you. But I'll go through it more as we get this week's earnings. But so far, the way things are shaping up, it is, it's not something that I look and say, well, this is, blow the barn doors off, but it's pretty solid. It is pretty solid here for the Bulls so far. Okay. All that said, where's the market? S&P, back at 3,000, right? Right here at the 3,000 level, just sitting there. We've seen it hit this level, several times. We've been dancing around it now for more than a week. We do have a fairly bullish, ascending pattern going on here for the market. Higher lows. Each sell-off is getting, to be less. We keep going back to those same highs. Breakout on. Well, it sure looks like we could be in that. But anytime you're dealing in one of these wedges, right? It's always okay. How much longer are we dealing, right? We could still set, several higher lows before some sort of real breakout. All right. So those are a few things there to consider. All right. All right, so challenge is running here with some Micron and on today's signal, and we'll run with that here into the close, and see what the signals bring here tomorrow and the rest of this week. Thanks for hopping on. Have yourselves a fantastic day, and we will talk to you tomorrow morning. Take care.